So income tax, Ind AS 1 or 12 income tax. What do you say in Ind AS? Ind AS 12 prescribe the accounting treatment of income taxes. So income taxes also required accounting. What kind of treatment you should have? So income tax na it may be payable or receivable. Payable na as a liability and a receivable na asset. Two things there. For the purpose of the standard, income tax shall include all domestic and foreign taxes. So usually income tax is not only Indian taxes, also other country taxes also to be included in this as per the India's. Income tax also include taxes such as withholding taxes, which is payable by subsidiary, associate, joint venture, and distribution to reporting entity. So now they are saying when we are doing consolidation, when you're doing consolidation, there will be a problem. What? Sir, the entity, other entity may even need to pay, they need to receive. That is also be considered into the income tax proportion. The principal issue of accounting of income tax, how the accounts of the current and future tax of consequences. What are the consequences? Future recovery. What is the future recovery? Settlement for the carrying amount of asset and liability that are recognized in the entity balance sheet. Future account, future settlement is there. Future liability carrying amount. There is a carrying amount that we going to receive in future. That is asset. Transaction, other events of the current period are recognized in the entity's financial statement. So there is some transaction, there is some events. What's the transaction? Sir, 26 years they are reflecting TDS has been deducted. So it is a transaction. The amount is deducted, going to be repaid soon. But in the case of events, sir, there is a remote possibility they going to waive off our expenses, waive off our tax expenses. What is tax expenses? Penalty. We have gone for proceeding to waive off the penalty. If they waive off the penalty, that is being recognized as an future expenses, contingent liability, then that is asset for us. Ind AS 12 also deal with the recognition of deferred tax asset arising from unused tax losses and unused tax credit. So unused tax losses and tax credit can be a deferred tax also been the presentation of income tax in the financial statement and disclosure of the information relating to income taxes. So what is a presentation? How is going to be disclosed? You need to say. So what is the presentation as per the balance sheet? It's going to be asset side or liability side. And disclosure in notes. Notes they say, sir, we have this as per Indian accounting standard we have followed. If we have any subsidiary, associate, holding company in various countries, what is a tax has been considered, what has been effect being given in our balance sheet that will be to be recognized and be noted. Ind AS 12 is based on the balance sheet approach. Usually, Ind AS 12 is a balance sheet approach. It requires recognition of all taxes, consequences of difference between the carrying amount of asset and carrying amount of liability and their tax basis. So, what is the carrying amount? Whether the opening balance, closing balance. This is the carrying amount. That carrying amount can be asset or carrying amount can be liability. This is what been said. And as per the tax base, no, as per the base of the country which is been located, India, Netherlands, Switzerland, Australia, which on the base on that country we may be taxes may be charged. That has been said here. Tax base of an asset, tax base of an liability. What is the tax base of asset? Amount which is deductible of tax purpose against any taxable economic benefit that will flow to an entity when it recovers the carrying amount of the asset. So when it is certain economic benefit arises, we will receive that amount. If the economic benefit will not be taxable, tax base of the asset is equal to the carrying amount. So when the economic benefit, so the amount what you're going to receive is not taxable, then the amount is equivalent to carrying amount. So what is the tax base? That is totally our income. There is no that is not going to be changed. The carry in case of tax base of a liability, carrying amount less any amount that will be deductible. Deductible, na? So I'm going to receive some amount from that as per the provision base. They're going to deduct something and give the remaining to me after cutting some portion. Okay, the tax purpose in respect of the liability of the future period, in this case, revenue which is received in advance. We have received the revenue, that is my revenue, but based on my proportion, this is considered as TDS provision. This is, you can see this is TCS provision. And can have direct example for this. Tax base is carried out less any amount of the revenue which will not be taxable in the future period. So future period there will be no deduction regarding that amount. Only once you deduct it, that is going to be taxed. Where tax base is not immediately apparent. When tax base is not immediately apparent, with certain limitation, exception, recognition deferred tax liability asset, whether recovery or settlement of the carrying amount of asset or liability would make future tax payment larger or smaller. And that would be if recovery of settlement were to be no tax consequences. So what is saying, sir, we have deferred tax. What is deferred tax? You need to see. So there is a difference in tax due to depreciation or another provision as per the deferred tax provision. So when the case, we'll say example. So depreciation of the company as per income tax. Company is higher and income tax is lower. Now it will become a deferred tax liability. You need to pay tax. When the company is lower and income tax is higher, this will become a deferred tax asset. So you're going to pay tax now, but you're going to consider as a deferred tax asset and you're going to sort it out with the future taxes. This kind of proportion make arise. Current tax. The current tax of the current tax for current and prior period shall be extended unpaid and be recognized as liability. Okay. So current taxes liability. The liability side, which is other current taxes, other current liability. You These taxes will be shown there. If the amount already paid in respect of the current and prior period exceeding the amount due to the period, the exceed shall be recognized as a. So I want to my current tax is 10 rupees. I paid 11 rupees. The 1 rupee to be current non-current current asset will be there. Other current asset it will be there. The benefit relating to tax laws that may be carried back to recover the current tax of previous period shall be recognized as asset. So whatever I made it recognized in the asset side, I will come again. The benefit relating to tax laws. So there is a tax loss and then there is some benefit from it. What is the benefit arising to tax loss? Can be carried back to recover current tax of the previous year shall be recognized as asset. So I had paid excess taxes. So that is in my other current asset. When I received, it can be sorted out. It can be carried forward. Temporary differences, taxable temporary differences, deductible temporary differences. There are three things. And deferred tax liability, deferred tax asset. These are the 5 points you're going to see. Sorry, temporary differences. What is temporary differences? The difference between carrying amount of asset or liability in the balance sheet and its tax base. So there is a carrying amount. Okay. Carrying amount can be carrying liability or carrying asset. Okay. In the balance sheet and its tax base. So as per the tax rate, you want to pay 110 rupees. You pay 111 rupees. 1 rupees is carrying amount. Okay. Taxable temporary difference. What is the temporary difference that will be result in taxable amount in determining taxable profit or future profit when the carrying amount assets and liabilities are recovered or settled. Taxable temporary difference. What is this? So we are doing the business of collecting TDS. We are doing a business of doing service sector. So in the service sector, we have employees. For the employees, we collect TDS. So, and this is also some problem due to our employees' records. So, we are not sure about the TDS amount that to be deducted based upon various circumstances. Circumstances we don't need to carry on right now. So, we have deducted excess TDS. Excess TDS we have deducted. So why, sir, we have 4 quarter, we need to pay back the TDS amount. As per the income tax provision, unutilized challan amount can be utilized in number of years. So we have paid a huge amount in 1 year. So that can be adjusted with other period. There's no issue. So such a way, we need to pay tax, we need to deduct tax for employees. For this instances, what we are doing is we are not we are using as an asset. That is tax paid is used as asset and there in the book that we are adjusting off. This is taxable temporary difference because we have completed the liability, but although we have completed liability, we have an liability to pay to tax which is there in the books of account. At the same time, there is a TDS deducted and need to be utilized with it. So the two clauses will be there. Okay. There will be two ledgers will be there. That going to be sorted off to the period of time. Next, temporary difference, taxable, deductible, temporary difference. What is there will be deductible, temporary difference? A temporary difference that result in the amount the deductible in determining the taxable profit or future profits when the carrying amount of the asset or liabilities recovered or supplemental. So, first, they need to deduct tax rate. Yeah. For deducting, there is a difference arises. Okay. So, of that difference is what they need to rather if they deducted higher, they need to pay back as low. If they deducted lower, they need to deduct by high. This is the thing. So they are that is going to be done, but that is also be recognized in the balance sheet as assets and liabilities. Temporary difference, taxable, deductible, before tax liability, before tax asset. Deductible is before tax asset, taxable is before tax liability. Any amount of income tax payable in future in respect of taxable temporary difference, then it is known as the taxable temporary difference, and it is known as what? Before tax liability, before tax asset, the amount. So, as we have seen earlier, we need to pay more tax due to the difference in what depreciation or a tax between company SAT and as per the income tax act. And due to this, liability arises. Taxable liability arises. That liability is deferred tax liability. Deferred tax asset is the amount of income tax recovered in the future period. Sir, I had paid difference. I had paid the tax right now. That tax I paid, I can carry forward until the circumstances is where I can sort it with actual income tax payable and deferred tax. When deferred tax liability is there, that to be asset is there that can be sorted because I pay the tax now, excess tax than the income tax I need to pay. Due to that, what I'm doing when the actual tax payable is there, I'm sorting out with the deferred tax. Then after clearing it, I'm paying the actual tax. So deductible temporary difference, carrying forward of unused tax losses, carry forward of unused tax credit. This is being a different words for deferred tax asset. Deferred tax liability should be recognized for all the taxable differences, except to the extent that is deferred tax liability arise from the initial recognition of goodwill or the initial recognition assets or initial recognition of liability. Transaction is not a business combination at the time of transaction. So this kind of transaction cannot be a business combination. Always it should be taxable thing. The affect neither accounting profit or a taxable profit. It influences the coherent of a recognized asset or recognized liability that is operating entity. Expect to recover or expect to settle the carrying amount of assets and liability. It should be expected to settle it. If the probable the recovery and settlement of the carrying amount will make a future tax payment larger, they're going to make a future tax payment larger. What they will do or smaller, then they would be of such a recovery settlement where it have no tax consequences. There will be no tax on it because there will be asset, there will be liability. That asset is going to be settled with the liability. At the same time, there is no flow of cash in this current period. It is based upon the flow of cash in the previous prior period. The standard requires entity to recognize deferred tax liability or deferred tax asset with certain limited exception. So it will be considered. Deferred tax asset should be recognized in all the deductible temporary differences. So all the temporary differences will be recognized. And extent that is probable, the taxable profit will be available against which the deductible temporary difference and unutilized. Okay. unless the default tax arises from initial recognition of asset or initial recognition of liability in the transaction. The transaction it arises, that is not a business combination. It is what comes from the business combination. So I have two business. One business has asset, one business has no always have tax expenses. So I'm combining this to become one C company. But to using this default tax asset, can I make a business combination business to not to make it tax, to solve. At the time of the transaction, it put neither accounting profit or non-taxable profit. And use tax losses and tax credit. What is this? The default tax asset, default tax asset should be recognized for the carrying forward and unused tax losses and unused tax credit. Yeah, there will be unused tax losses. So I have paid tax, so can asset, and I have credit that is being carried forward. The extent that is probable future taxable profit will be available against which unused tax losses and unused tax credit can be utilized. What I was saying, so when the tax expenses arises, you can utilize this credit and you can use this tax losses to set off this tax payment due. It is inherent in the recognition of liability that the carrying amount will be settled in future period through outflow of the entity of resources embodied in the economic benefit. So sometimes when it is more to pay, we use the economic resources to settle it. When the resources flow of the entity, a part of them or the amount when we deductibly determine the taxable profit of the period later that the period in which taxability is recognized. In such cases, the temporal difference exists between the carrying amount of liability and carrying tax. Sometimes there will be a temporal difference between what is a carrying amount and what is a tax bill. And that to be recognized as a liability or as an asset based upon the differences. The entity recognized for tax asset only when it is probable that tax profit will be available against the deductible temporary differences and will be utilized. Only when there is a difference, you can increase unless there is no nothing. An entity settles whether taxable profit will be available against when it is utilized deductible temporary profit difference. It is considered whether the tax law restrict the source of taxable profit and against which is maybe deduction is a reversal of deduction temporary difference. If the tax law imposes no such reduction, when there is no restriction, the entity assesses the deductible difference. And there is no difference, not to the difference in combination with all other deductible temporary requirements, whether the tax law restrict the utilization of losses to deduction against the income specific. So there is tax losses. So if the government, the law will prohibits to use this until that says prohibit to use this credit and losses become restricted. If there be restriction, you will need to pay tax and carry forward. A detection difference in the assets in combination one three, which is a detectable temporal difference of the appropriate time. What is a measurement? Measurement. Current tax liability, a current tax asset for the current and prior period shall be measured the amount expected to be paid or recovered from the taxation authority using the tax rates and tax laws, and that will be enacted or substantially enacted by the end of the reporting period. So whatever you current tax liability you are measuring, it should be appropriate to what's for the tax laws of Indian government and other country tax laws and tax rules and tax regulation. Other than that, you can use some appropriate method. Only as per the tax, that amount should be recognized as current tax liability. Default tax asset and default tax liability can be measured at the tax rate that are expected to be applied to the period when the assets are realized and the liability is settled based on the tax rates and tax laws that has been enacted or substantially enacted by the end of the reporting period. So as per the tax rate action will be the default tax asset and default tax liability should not be the discount should not be discounted. So they should not be the discounted rate because the actual revenue. So the current period of April, I'm going to pay this month. I'm in the January. I can discount it and give it a present value. Can I give a tax rate? No, no. A present value of tax rate is should not be like recognized on the default tax asset or liability. Okay, that's no because present rate is allowed. Discounting is not allowed. current and default tax relating to transaction recognized in other comprehensive income, equity, other relation to transaction advantage. So default current as and default tax is recognized in other comprehensive income in equity as a income or expense in profit or loss account, but related to transaction in others comprehensive income, equity, or any other. But they have not said income or expense account. What is offsetting? The entity shall offset the current tax asset and current tax liability if any 1 year with the entity. Another as a legal enforcement right to set off the recognized amount. It has a right to enforce it. And intends either to settle on a basis, realize the asset and realize the liability, and similar to employment condition. The entity shall opt the default tax asset and default tax liability if any there. Okay. You can offsetting is there, and there is a plus, there is a minus, you can offset. But all the assets and all the liabilities can't be offset. When it is permissible, when it is enforced by law, so it can be offsetted. If that has been the rules, they can do. If there is no such permissions involved in that, you can't offset the current asset with current liability. Entity has a legal enforcement right to set off the current asset and current liability. There should be legally enforceable right to do so. If there is no right, that should not be done. The default tax asset and default tax liability relating to income tax levied by the same tax authority that some taxable entity, default tax entity which intend to either to settle the current tax liability and current tax on net basis, or realize the asset or settle the liability simultaneously. In each future period, a significant amount of default tax liability or default tax assets are expected to be settled or recovered. So, then after the settlement, may come to net basis, the asset can either may become positive or negative. That is, a maybe asset or can be liability. This all should be done as per the taxable authorities' permission. A disclosure, they have given order, they have given notification to do so. Authority should be permissive to it. What are the description? A major component of tax expense shall be disclosed separately. It should be separate. What is income tax? What following? Other country, what does it follow? Any other deferred taxes that you need to follow, deferred liability you need to follow. And if you have made any changes, you need to follow. These are the things being said. Then allocation. The standard requires the entity or to an account of tax consequences of transaction, and other given the same way it accounts for the transaction, other you might have mentioned. So the standard should see how the accounts and transaction and events has been accounted. The same how the transaction is accounted, event has been accounted. If the major event to be disclosed, you need to disclose and how the amount has been said. What is the future consequences? Everything should be said. Even the transaction and other events, revenues and profit and loss, any related tax etc. Also outside the profit and loss, either in comprehensive income or directly entity. The related tax effects are also recognized outside the profit or loss account, either in the comprehensive income or directly in the equity, respectively. Okay. Similarly, so where they can disclose, so they can disclose in comprehensive income, they are disclosed in equity, they can disclose in other, or they can disclose in profit and loss account. These are the where they can disclose what the transaction other even outside the profit and loss account na there by relating tax effect na when the comprehensive income direct equity respectively outside na P&L account. Similarly, the effect of amount of goodwill arising in the business combination or the amount of the bargain purchase gain recognized. So sometimes we need to recognize goodwill or sometimes we need gain. What is goodwill? Sir, I'm buying the business for more than the value of the books. That's goodwill. Less than the value of books, then it is gain. Appendix A, Ind AS 12 address how the entity should account for tax consequences of change in tax status and change in shareholders. So, how they be accounting this change in tax status and shareholder should be given. The status, why this tax shareholders is important right there. If in the case of foreign shareholder, Indian shareholder, domestic shareholder, everything is involved. The appendix prescribe the change in the status of the entity in the shareholders does not give rise to increase or decrease in amount of recognized outside profit and loss account. When the company can become a domestic company can become an company outside company, that is foreign company based upon the shareholder pattern. True. Uncertainty over income tax statement. What is uncertainty? Appendix. A statement clarify how the apply of recognition of measurement requirement of Ind AS 12 when uncertainty over the income tax statement. There may be, as per the income tax treatment, we may say some, but uncertainty. So example, penalty has been given to 243, 234A, 234BC, but the department may give a consideration to waive of it. So when they waive off it, we don't know it's certain, but if they waive off, that is became an asset or liability. At rate if they've been charged as expenses to be considered as asset. So these are the things regarding income tax in the AS 12. Thank you.